classic saying of don't put all your eggs in one basket. If I'm only wearing winter clothes, that may be fine for the winter, but when summer comes, I'm not going to be as able to adapt and probably suffer in that summer heat. It's kind of shocking to me, and at the very least fascinating, that investors don't apply that same logic to their investment portfolios.
Hello, everyone, and welcome to the podcast. Today, we're going to talk about the importance of diversifying asset classes. Joining me is the one and only Nathan Loy, who is the Director of Strategic Planning at Viking. I'm your host, Ravi Gupta, the COO of Viking Capital Investment. For this episode, I'm basically here for eye candy, and Nathan is going to bring the substance to this episode. So if you're not watching on YouTube, just switch over so you can see me and you can see Nathan.
Thanks, Ravi. Hope to one day kind of be at the pinnacle of titles and be the eye candy of future episodes, but we'll get there. A lot of work to be done before then.
Yeah, maybe a few years you'll be there.
Exactly.
Okay, so let's start by talking about asset classes. Why is diversification important in building wealth?
Yeah, absolutely. So for me, taking a step back, we all pretty much diversify in our daily lives, right? The clothes that you wear, the workouts that you do. Generally, you want to manage your risk and not be kind of exposed in one area or the other. It goes back to that classic saying of don't put all your eggs in one basket. Same thing. If I'm only wearing, winter clothes, that may be fine for the winter, but when summer comes, I'm not going to be as able to adapt and probably suffer in that summer heat. So it's kind of shocking to me, and at least at the very least fascinating, that investors don't apply that same logic to their investment portfolios. So when we're talking about asset classes, we're talking about the different investment vehicles that you could invest in, right? There are kind of 5 major asset classes. There are stocks, bonds, real estate, commodities, and then kind of a new one that popped up, crypto or kind of other financial arbitrage. So we'll get to kind of the risks and different kind of return profiles of those different commodity classes. But generally, when we're speaking about asset classes, we're just talking about different investments that you could do.
Right. So there's so many ways to diversify, right? You could diversify over asset classes. If you're looking at a particular asset class, you could diversify over geography. You could diversify across different vintage type apartment complexes. If you're investing in apartments, you could diversify retail, residential. There's so many different ways, but I think to your point, the key here is you want to diversify as much as possible to decrease your risk. And I'll just give you a couple quick personal examples. There was a deal, it was a CBD deal. The deal, this was, back when the CBD craze was in full swing. And I thought it was an amazing investment. I thought it was a way to diversify. When I looked at the pro forma, it was just blowing it out of the water. And I'm like, okay, I'm putting money into this, but I made a smart decision. I said, I'm not going to put in a ton. I'm just going to put in a little bit into this. And then I said, I'm putting a little bit into real estate. I put a little bit into another solar project that I was working on. But because I know real estate, more than the other asset classes, I put more and more in that. And it turned out that because I diversified, I was able to overall do well in that portfolio. If I put it all into that CBD deal, which was blowing it out of the water, I would have lost pretty much everything. The deal is not performing at all. And it just, you never know. It's sometimes the sponsor could be, have their best intentions, put it out there and really sound like they know exactly what they're saying. And the deal looks like it makes so much sense on paper, but you just don't know what's going to happen. And Nathan, maybe you could share about, experience you had where a Viking deal or some other deal maybe didn't perform as well as thought it would, but another deal blew it out of the water.
Yeah, absolutely. We can go back to a Viking deal, one that we picked up a while ago, a couple years ago now, Main Street Village. It was something that, was a little bit outside of what we had traditionally done. It was a much larger deal in a newer submarket, but we saw the growth, we saw the employment, the strength of that employment in that specific submarket. And so it made all, perfect sense to go all in, where we really hadn't diversified to that scale of property before that location. It kind of goes back to what you were saying. For me, there's different tiers of diversifying, right? You can diversify across different asset classes, whether that's stocks, bonds, real estate. And then within each one of those, asset classes, you can diversify even further. So let's say you chose real estate. You can choose to go with retail, industrial, mobile home parks, multifamily. You can diversify across those asset classes that are kind of a subcategory of kind of the larger picture. And then even within those, subcategories, you can diversify even further. So you can diversify across location or sponsors. And then once you get down to the deal level, You can have another level of diversifying by investing in, class A or class B or a different kind of class that would have a different return profile. So it's all about kind of balancing that so that you have kind of the highest yield and the lowest risk. I mean, ideally in any sort of investment, that would be the ideal investment where there's tremendous upside and very minimal downside.
Yeah, and you mentioned class A and B. Could you describe that further? What does that mean exactly?
So the way that Viking is set up is we have class A, which is pretty much a straight cash flow play. There isn't really any upside on the acquisition or on the sale of the property. It's mainly producing a consistent return over the hold period. And that differs from a class B, or what we call a reserve class, where there's still that consistent cash flow payment, but there's also upside when we go to sell the deal. Typically, when you hear people talk about pref payments, that's the standard cash flow payment that you would receive. And then when they talk about splits, whether that be a 70-30 split or an 80-20 split, what they're talking about is after you have those cash flow payments and after you return the capital to the investors, you then take part in the profits, the upside. And typically the majority of that goes towards the investors. So in the example of 70-30, 70% of that upside would then go to the investors and 30 would then go to the sponsors or the operators of the deal.
A personal example of that is I not only invest in Viking Capital deals, but I invest with other sponsors. It really helps me get an idea of what they're doing differently, what they're doing the same as us. Some of these sponsors invest in different geographic areas, so I can get a sense of how those areas are doing. And it's just really beneficial from so many ways investing with other people. And there's certainly sponsors now that I've invested in that I'm not going to invest in the future because I know that they don't communicate as well as I'd like, and they don't perform as well as I'd like. They're not as efficient as I would like. Whereas others, I'm very impressed by, and those people I'm trying to emulate some of their ideas. As that's me as a sponsor of multifamily. But if you're a passive investor, this would be a really good idea too, because then you could focus on, after you invest with multiple sponsors, there may be one that's outperforming, and you could really focus on investing more with them.
Yep, absolutely. And for those of you who don't know, when we talk about stocks, bonds, commodities, what those are, I just want to clarify that real quick. So stocks, you're traditionally investing in a specific company. So typically as the valuation of that company goes up and they have stronger fundamentals, the price of that stock increases. And if, the canonical buy low, sell high, that's typically what bonds are. What stocks are. Bonds are using your capital as more of a debt vehicle. So you're lending it to either the government, essentially hard money lending where you have a kind of a fixed rate of return. Real estate is kind of what our bread and butter is. It's investing in a hard asset that has cash flow and appreciation. You also have commodities, which are typically raw materials, like investing in gold and silver. Those are typically seen as pretty stable. And then, as I mentioned, they have this kind of new class of, crypto and more kind of financial arbitrage. And for me, like the strength, or at least the way to gauge the risk profile, is how much foundational support does that asset class have? Or if you're talking about, what you're just talking about, Ravi, with the sponsors, what's their track record? What kind of assets are they investing in? Or if it's a crypto coin, how robust, what's the market cap of that specific coin? What is the fundamentals that really make it a good investment? Because ultimately, when you have investments that are extremely high yield, they're typically high risk investments as well. So there was some crypto, coins that had tremendous double-digit, even triple-digit returns, but there was so much volatility in that market that you really had to have a strong risk appetite for that to make sense.
Yes, absolutely. And, the other thing that you mentioned, Nathan, was as far as stocks and bonds go, it's in a similar way, there's equity and debt in a real estate investment. So you can actually invest in debt as well, which is surprising to a lot of people because whenever you think about debt, you think about banks and lending that money, but there are companies out there that will allow you to invest, and they have what we call a debt fund. And with that fund, they supply debt to various operators. A lot of these people are like fix and flip type folks that they supply the debt to, but this is a very safe way to invest because debt on average is safer than an equity play, just like bonds are a safer play than stocks. You don't make as much on that play, but it's still a good way to maintain your diversification and maintain your cash flow. And in some instances, you may be able to invest in the debt and then the equity, and then you can invest in different classes of equity, as Nathan mentioned as well.
Yep. That's one of the great things about funds is that you have, pretty much one investment, and then that fund then distributes it and kind of de-risks your investment across multiple multiple different platforms.
Excellent. What about mistakes, Nathan? What kind of mistakes do people make, and how do you avoid these?
I mean, with anything in life, there's always kind of that continuum, right? So you have people that over diversify or under diversify. That's really kind of the greatest mistake, alongside choosing poor investments. But I'm talking about from a diversification standpoint. There are people who take this to the nth degree, where they will diversify across all the different things that we just said, right? Asset classes, locations, stocks, bonds, commodities. And that can work, but it's almost as if you're trying to learn a new skill and you spend maybe 5-10 minutes at each different skill you're trying to learn. You may be somewhat adept in learning that skill, but you're not going to grow and be kind of an expert in any one category. So what a lot of people will do is they'll choose kind of one or two of the major asset classes and then dive deep and diversify among those asset classes. Then you have kind of the flip side of the equation, where people aren't diversifying enough. So some people, I've seen, investors plug all their money into commodities or just precious materials or raw materials. And that can work for a time period, but as you know, everything's cyclical, and even the yields that you get are cyclical from these investments as well. So let's say, hypothetically, we have an investor who invests every dollar into gold, right? The price of gold, over time has risen. But let's say, hypothetically, that they find a gold mine, and now there's a new flood of supply that comes to the market. Your entire investment portfolio is going to tank with that price of gold tanking as well. So that's kind of one of the benefits of diversifying, that even if one aspect of your portfolio has lower returns, if you have diversification, you can kind of balance that with higher yield investments. Again, it goes back to the whole risk and return profile too.
Great. Okay, so let's give the listener some practical advice here. Nathan, imagine you coming in, you've got some money to invest. This is a multifamily real estate podcast. That's what we focus on. So how would you invest your money? Let's say you've got like $1 million. How would you invest it?
Yeah. First off, I would start investing with asset classes and kind of business models that I know. For me, that's always an easier kind of lower barrier to entry, where I don't really have to kind of grasp my head around what I'm actually investing in. That's also kind of a major risk, is I've seen people have entire stock portfolios, but they have no clue why they've arranged it the way they have. So for me, I go all in multifamily in terms of, hey, I know multifamily, I know real estate's a great wealth building tool. Then I would diversify across different locations, and I'd choose primarily major MSAs, or at least secondary and tertiary markets that had high growth. There's a bunch of reports that you can read from Berkadia, Marcus and Millichap, CB, for example. They all produce amazing data for why these are strong markets. Once I kind of chose my market, I would then say, all right, how can I kind of diversify across different asset types? So, I might be looking for a value add deal that has a bit more upside, and then I'd balance that with kind of a more core plus deal that has consistent cash flow, but not as much of a value add play. Once I kind of locked those in, I would then say, all right, what sponsors are serving these markets and these asset classes? And then I do primarily the majority of my research on the sponsor itself. So what's their track record? Have they exited deals before? What kind of deals are they picking up? What's their communication style? What are the group of investors that typically invest in these types of deals? And then I'd really deploy it. That's kind of the major risk too, is sitting too much on the sidelines and having too much analysis paralysis. You want to deploy your capital. And some investments are going to do better than others, but at least you have time in the market rather than trying to time the market itself.
Yeah, and what you said there is very important. It's basically dollar cost averaging, right? You want to invest. If you think the market is down and you've got a deal that makes a lot of sense, you have a sponsor you trust, it's in an area that you really enjoy or you like, put some money into that. If the market is up and it's hot and everybody's starting to invest, put a little bit of money in that too. So over time, your investments will average out. And again, you're investing over various cycles. That's another way to diversify. And also, here at Viking, we're happy to look at other people's deals too. If there's a deal that you're looking at and you're like, oh, this looks really good, let me ask my friends here at Viking what they think. We'll give you our honest opinion. We diversify in our personal investments. We're happy to help and, point out, whatever we see there. So anything else, Nathan, that we should say to close?
Yeah. For me, it goes back to kind of understanding what your investments are, and then what your risk and return profile is. We didn't really talk too much about that. But ultimately, any investment is just a gauge of your risk and return. So, depending on where you're at in life, if you have a family, if you're single, if you're kind of in your younger years or your later years, you're going to have different return profiles, and you want to find investments that match that risk and return kind of appetite that you have, and know that that's going to change over time. It's kind of like almost kind of like pruning a bush, where you don't want to, have it grow endlessly and not really keep track of it. You want to kind of mold your portfolio to where you're at in life and what would best serve you, while also mitigating your risk along the way.
Okay, Nathan, thank you so much. This was phenomenal. It's a simple message to diversify, and some people may say, "Oh, I understand this. I know what this means." But I really feel like the points that we discussed today are really important to consider, because there's so many different ways to diversify, and there's so many ways you can protect yourself and your investments. So I hope you, as listeners, got a lot out of this. And as always, feel free to contact us anytime with any questions. Thank you.
Thanks, Robbie.